is lecture 5-2, and we're going to be starting chapter 4. This is for accounting 260. So, as we said, we're looking at accounting tools for business decision making. Um, chapter 4, accrual accounting concepts. It is very important to understand who the users of the information, financial statements. By information, we're talking about the information in the financial statements are. Remember that the information in the financial statements you are preparing are to be used by outside parties outside of the business who don't know what's going on inside the business but want to know and need to know. So in order for these parties to use the information in the financial statements, everybody has to understand the rules used to prepare and present the information in financial statements. So this basically says that there are certain rules that we have to follow when preparing financial statements in order for everybody to be able to understand the information presented in financial statements. For example, if I was speaking Martian, none of you would understand a single word I say. But we all have a common language, English, that we all understand. And in English, there are rules of grammar, rules of speaking that we all know and understand. So I'm following those rules of grammar and the rules of speaking, and you're understanding me because you also know those rules of grammar and rules of speaking. It is important for everybody that wants to use a financial statement to make decisions about whether to invest in one company or not to, understands what the information means and how the information was prepared, under what rules the information was prepared. So the users of the financial statement are using the financial statements to make decisions about the business. For example, do I want to invest my money in that business or do I want to invest my money in another business? A bank loan officer may say, do I want to loan money to this business? And he or she will use a financial statement to make that determination. Well, in order for investors or bank loan managers to use the information, they have to understand what the information means and under what rules the information was prepared. As I said, just like if I was speaking Martian, none of you would understand anything I'm saying. But since I'm speaking English, a common language, you all understand exactly what I'm saying. Another example is just like it's important for everybody who drives a car in the United States to understand the rules of driving. One of the rules of driving is speed limit 65. You got to follow speed limit signs. So when you see the sign shown below, the speed limit 65 sign, everybody knows that they are only allowed to drive 65 miles per hour and not faster. So that is a rule of the road. The speed limit sign says 65. You're not supposed to drive faster than 65 miles per hour. Another example is when you see a stoplight, it tells you what to do. For example, if the stoplight is showing the red light, you are to stop. You are to not move. If the stoplight is showing green, you go. If the stoplight is showing caution or yellow, you exercise caution in proceeding. You can proceed, but with caution. So when you see the sign shown below, depending on the color light shown, everyone knows how and when to proceed in traffic. As I said, If the light is shown red, you stop. You don't move. If the light is shown green, you go. If the light is shown yellow, you proceed, but with caution. It's the same thing here. Everybody knows everybody who drives knows what the color lights mean. Red means to stop, green means to go. So what are the rules everybody has to follow when they prepare a financial statement? First, we have some assumptions about the business entity that prepared the financial statement. So we have to understand what assumptions we are making when we prepare these financial statements. Again, just like when you drive, you assume that all the other drivers on the road are going to follow the stoplight colors. So all the other drivers are going to stop when the light is red or go when the light is green. We make that assumption about the other drivers on the road. We make the following assumptions about the entity, the financial statements, the period in which the entity is reported. The four main assumptions in financial accounting are the monetary unit assumption, the economic entity assumption, the periodic assumption, and the going concern assumption. So what is the monetary unit assumption? The monetary unit assumption requires that only things that can be expressed or measured in dollars or money are included in the financial statement. So in relation to the assumptions that we talked about, what assumptions are we making when we hear this monetary unit assumption? So in relation to the assumptions we make about the entity, the financial statements, and the period in which the entity is reporting, this would simply mean that we assume that the company included only items that can be expressed or measured in money or dollars in its financial statement, just like we assume all the drivers are going to stop, all the other drivers are going to stop when the light is red and go when the light is green. We simply assume that the company prepared the financial statement and all the information in the financial statement included in the financial statement are items that can be expressed or measured in money. So what about the second one? What is the separate economic entity assumption? The separate economic entity assumption is that the owner of the business is separate from the business itself. So in relation to this assumption and how it relates to what the assumptions we make about the entity, the financial statement, the period in which the entity is reporting, this would simply mean that we assume that the company only included information about the entity in its financial statement. So there would be no information about the owners or other businesses in the financial statement. With all the information in those financial statements are about that single entity that we're reading about. Again, just like we assume that the other drivers will stop at a red sign, we are making the assumption that there's no other information in the financial statements except that information that pertains to that entity. What is the periodic assumption? The periodic assumption is the life of the business should be broken down, divided into artificial time periods. The life of the business should be broken down, divided into monthly, quarterly, and annual periods. So in relation to the assumptions that we make, how does this assumption relate to the entity, the assumptions we make about the entity, the financial statements, and the period in which the entity is reporting? This would simply mean that we assume, again, that the company broke its financial statements into artificial time periods and only reported that information that pertains to that specific time period. They didn't include information from other periods. So that the separate entity assumes that they didn't include information from other businesses, and the periodic assumes that the information is only for the period that it's reporting, not for any other period. So here's the periodic assumption. We basically break it down into months, quarters, and years. So a financial statement will report a quarter, a month's worth of activity in a company, an entity's company, and only that entity, a quarterly, a 3-month period, or a year, 12-month period. What is the going concern assumption? The going concern assumption states that the business will remain in operation for the foreseeable future. So in relation to the assumptions we make about the entity, the financial statement, the period in which the entity is reporting, how does the going concern assumption relate to those assumptions? This would simply mean that we assume that the owners of the company expect the company to continue in existence for at least the foreseeable future, if not forever. So a corporation or a business can sell ownership, as we said in chapter 1. So as owners die, they will pass the ownership on to other people, either by selling it or by giving it to their heirs. But the business itself will continue into the future. Just like assumptions, we have principles. Just like assumptions, we have principles. There are certain principles that financial preparers are supposed to follow when preparing financial statements. Again, when you see this sign shown below, there is a certain principle that says drivers will only go this fast and no faster. That is a principle, a law, a rule that we must follow. Same thing with the stoplight. There is a principle that says that when the stop sign shows a red light, we will stop, and when the stop sign shows a green light, we will go. So there are 3 main principles of financial accounting. There's the historical cost principle, the fair value principle, and the full disclosure principle. What is the historical cost principle? The historical cost principle simply states that the company will record the value of the assets it purchased at the cost and price in which the company paid. So in relation to the rules, principles that financial statement preparers are required to use to prepare financial statements, this simply means that the financial statements preparers are required to use cost, the same thing as historical cost. Historical cost is the same thing as cost, to record the value of assets purchased. What is fair value or market value principle? The fair value or market value principle requires that certain assets and all liabilities should be reported at full, fair, or market value. So in relation to the rules, principles that financial statement preparers are required to use to prepare financial statements, this simply means that financial statement preparers are also required to use fair value or market value to report the value of certain assets and all liabilities, all amounts that I owe to outside parties, have to be recorded at the value in which I'm going to have to pay them back at, or market value. The full disclosure principle requires a company to report all circumstances and events that would make a difference to the user of the financial statement. So in relation to the rules, principles that financial statement preparers are required to use to prepare financial statements, this simply means that financial statement preparers are required to ensure that they have reported to the users all circumstances that would make a difference in the decision a user of the financial statements would make. I'm required to disclose all those circumstances, that information that would change a user's mind. So if a user would have decided to invest in a company, had they not been shown this information and they changed their mind based on that information, that is what the full disclosure principle requires. Remember, financial statement users are reading the financial statements to make a decision as to whether to invest in the company or invest in a different company. And the full disclosure rule simply requires that companies disclose all circumstances, all information that would be considered to users in making that decision. The revenue recognition principle. This is basically a principle of when do we recognize revenue? When can we recognize revenue for the company? There are rules about that also. We recognize revenue in the accounting period in which the performance obligation is satisfied. We're going to discuss this in a second. There are 5 rules or steps in revenue recognition. First one is identify the contract with the customer. A contract is an agreement between 2 parties that creates enforceable rights and obligations. Sierra has a contract with the Lewis family to provide guide services, for example. Look. So first you have to have a valid contract with a valid customer. Somebody wants to buy your product. A specific person, identified person wants to buy your product. Second, we have to identify the separate performance obligations in the contract. What am I going to do for this customer? So I have to have a specific, identified, real customer. That wants to buy my product or service. Step 2, identify the separate performance obligations in the contract. Sierra has only one performance obligation to provide guide services. If Sierra has agreed to sell the customer camping equipment, a separate performance obligation is recorded. But in this case, Sierra provides guide services. That's what they do. That's what they're in business to do. So when their performance obligation is to provide guide services. So this simply says, what is the customer going to get from the company? Are they going to get guide services? Are they going to get, if you're Walmart, you walk into a Walmart, are you going to get a shirt? So there's an agreed upon price. What is the company going to charge the customer for the product or service? And the customer has agreed to pay that price. The transaction price is the amount of consideration that a company expects to receive from a customer in exchange for transferring a good or service. So Sierra charges $1,500 for its guide services, and a customer has agreed, the Lewis family has agreed to pay that. Sometimes there are one, sometimes there are many performance obligations. In this case, example is only one, to provide guide services. So Sierra is required to provide guide services to the Lewis family. Once they provided guidance service to the Lewis family, step number 4 is satisfied. So in step 5, when the performance obligations identified in step 4 are satisfied, we can recognize revenue. So in the example, the Sierra recognized revenue for providing guide services to Louisville when it satisfied its obligation, the completion of the guide trip. In a second, we're going to go through an example. So here's an example of the application of this. Step 1, identify the contract with customers. In this case, we have specific customer name. So let me read first, I'm sorry. Flint Corporation produces specialized machinery for the construction industry. April 2019 is Flint's first month of operation. So they're in the business of building and delivering specialized machinery for construction companies. Flint's first month of operation is April 2019, so these are the first customers. Flint provided the following production and billing data for its first month of operation. So the first step was identify the contract with customers. These are all specific customers that can be identified that want to buy Flint Company's machines. So step one is identify specific customers. And this is how we do it in real life. We have a contract with a customer. We have a customer name, an invoice amount, an invoice date, delivery date, completion date, all that. So all these, A, AAA, A, C, B, D, C, AAA, X, and Z. You can tell I'm not really that imaginative, am I? Are all valid customers. That meets the requirement for step one. We've identified the contract with customers, with real customers. Step two says identify the separate performance obligations in the contract. In this case, there are only one performance obligation. The only performance obligation that Flint has is to build and deliver the machine to the customer. So here are all the machines that the customer purchased. AAA wants a machine 1, A wants a machine 2, C wants machine 3, so on and so forth. So the performance obligations for each one, for AAA, for example, is to deliver a machine, to build and deliver a machine for it. The performance obligation for A is to build a machine, a specific machine for it. Same thing with C, same thing with B, same thing with DC, same thing with AAA again, same thing with X, and same thing with X, or X and Z. The whole obligation in this case is to build and deliver a specific machine to these customers. Step three, determine the transaction price. In this case, the contract price is the price Flint is charging the customers, which is the invoice price. So we have a transaction price. It's the amount of the invoice that we're going to send to each one of these customers. And we're going to send those invoices on the date we ship the machine. So on 4/20, AAA, customer AAA will receive an invoice for $20,000. On 4/24, customer A will receive an invoice for $60,000. On 4/22, customer C will receive an invoice for $80,000. On 5/12, B will receive an invoice for 20,000. On 430, DC will receive an invoice for 30,000. On 428, AAA will receive an invoice for 70 grand. On 430, customer X will receive a invoice for 45,000, because these are the agreed upon price. Step 4, allocate the transaction price to the separate performance obligations. As we said earlier, the only performance obligation is to build and deliver the machine to the customer, then the entire invoice price is assigned to that single performance obligation. So as I said, when Flint delivers the machine, then customer AAA has the obligation to pay $20,000. So on 420, Flint is going to deliver the machine, and at that point, AAA has a responsibility and obligation to pay $20,000. On 424, they're going to deliver the machine to A, and at that point, A has an obligation to pay the invoice price of $60,000. Step 5, recognize revenue when the performance obligation is satisfied. Since, as we said earlier, the only performance obligation is to build and deliver the machine to the customer, then the entire invoice amount is assigned to that single performance obligation. In this case, the single performance obligation is satisfied when the machine is built and delivered to the customer. So again, on 420, when Flint delivers the machine to AAA, they will have the rights to receive, and AAA will be obligated to pay 20 grand. Let's just go through the steps one more time. Step 1, identify the contract with customers. So here we have specific real customers that want to buy our product, that have agreed to purchase our product. Take whatever notes you want to take. Step 2, identify the separate performance obligations of the contract. So in this case, the performance obligation in the contract is for Flint to build and deliver the machine. Step 3, determine the transaction price. In this case, transaction price, the agreed upon price, is the price that the client is going to be invoiced. In this case, the contract price is the price Flint is charging the customer, which is also known as the invoice price. Allocate the transaction price to the separate performance obligations. In this case, we only have one performance obligation to build and deliver the machine. But if we had others, then this would get more complicated. Since, as we said earlier, the only performance obligation is to build and deliver the machine to the customer, then the entire invoice amount is assigned to the single performance obligation. In this case, the single performance obligation is satisfied when the machine is built and delivered to the customer. So here's a little exercise. Try this exercise out by yourself. On April 22nd, 2019, for what customer and what amount of revenue would Flint recognize? Okay, let's move on. So the answer is D, customer C only, and the amount is 80,000. Why? Well, on April 22nd, the only delivery that we're going to do is this, this machine, the machine to customer C. All the other delivery dates are not the 22nd. We do not care about the completion date. We care about the date the thing was delivered. Because that's the performance obligation, to build and deliver a machine. So the only one that we can recognize revenue for is C. And the only amount is 80 grand. As you can see, the other delivery dates are not on 4/22. And they asked specifically on April 22nd. Between April 1st and April 24th from what customers and what amount of revenue will Flint recognize? Take a minute to do this. Okay, so the answer is B. So just go down the list and identify those deliveries that have been made. What machines were delivered already? Well, between April 1st and April 24th. Well, AAA got their machine on 4/20, and that was $20,000. A, customer A got their machine on 4/24, and that was 60,000. C got their machine on 4/22, and that was for 80,000. The rest of them are 5/12, 4/30, 4/28, 4/30, and 5/2. Those are all after 4/20, April 24th. So the only ones that Flint can recognize are AAA, A, and C for 20, 8, 60, and 80. 20, 60, and 80. AAA, A, and C. Because the delivery date is 4/20, 4/24, and 4/22. This doesn't matter. The data that I completed in the factory doesn't matter. Because the performance obligations are to build and deliver. So we cannot recognize revenue until we deliver. Let's try one more. Okay, so which answer is true? We know that AAA has already received theirs on 4/20, so they qualify. A received theirs on 4/24, so that's between the 20th and 28th. C received theirs on 22nd, and AAA received theirs on 4/28. B received theirs on B received theirs on 5/12. DC 4/30, X 4/30, and 5/2. So the answer is A. X would be incorrect because they delivered 4/30. So that would make C incorrect. And again, X is incorrect, and so is DC incorrect. So that would make D incorrect. Okay, so remember again to review a little bit, the revenue recognition process requires 5 steps to be performed in order to recognize revenue. The first step is you must identify real customers. There must be actually a customer that wants to buy your product. You have to identify the specific performance obligations that the company must do in order to receive payment. Determine the contract price. That's the agreed upon price between the customer and yourself. Allocate the transaction price to separate performance obligations if necessary. And then when the performance obligation is satisfied, you recognize revenue. So let's look at some other examples. So for example, Dr. Sheldon Cooper started Big Cooper Inc. to fund and develop a time machine. The time machine has been developed, and time travel servers are now available to customers. According to the contract, customers are required to provide 40% deposit on their time travel service upon signing the contract. When should Big Cooper recognize revenue? The answer is when the customer has provided his or her time travel service. That's when the performance obligation has been met. So the performance obligation for the client, real clients want to travel into time, back and or forward into time using the Big Cooper Inc. Time machine. So that's what they're paying for. And Big Cooper Inc. can recognize revenue when they've provided that specific, when they've satisfied that obligation by providing the services to their customers. So, another example, when you drive up to a Shell company, to a Shell gas station to purchase gas, you purchase $30 worth of gas. When should the Shell gas station owner recognize revenue from your purchase of gas? The answer is, again, when the specific performance obligation is met. What did you go to the gas station to do? To purchase gas. When did you receive the gas? When you dispensed the gas into your car. So when you dispense the gas into your car from the tanks, that's when the performance obligation were met. Okay, we're going to close this out.